For more on the banks, let's bring in RBC Capital Markets' Gerard Cassidy. Gerard, great to have you with us. Do you think for the regionals, if you take a look at a regional bank index like the KRE, do you think that we've seen the worst of it stock-wise for this group?
I do think the biggest percent declines have already happened. And as you guys have just been talking about, are we near a bottom? That is the question. And I think we are going to be bottoming here in the next couple of weeks because we all want to see the data from the first quarter. The first quarter data will come out in April, and that's what we want to see, particularly on deposits.
I feel like the big question, though, Gerard, is when you think about the bank, I mean, it's fine to know that we're closer to a bottom, and that's theoretically good, but we don't know what it looks like on the other side in terms of the operating environment, in terms of regulation, et cetera. And so what does your model look like if we don't know those sorts of factors?
I think we should all take into account, similar to past periods when we've gone through a crisis, particularly 08, 09, we know more regulation is coming. So there probably will be lower profitability, but with the sell-off in the stocks, it appears to us that it's overdone, even with the expectation that we'll see lower profitability due to increased regulation over the next couple of years.
Gerard, and I hear you on this, and I think you're right. We're asking that question on when is the low. But I care a lot about your view, the analyst community's view, to the discount rate we're putting on banks, to the unknown, to a world where banks were re-rating over the last 2 years. The payout levels were going higher. The buybacks were going higher. These are all reasons for people to get excited, but also the analyst community to price banks at a different level. What are you doing, or what do you think the community is going to do in the next few months?
I think you're getting right to the point on valuation, because you're absolutely right. Following the financial crisis, the valuations dropped and we had to reset. And then what we saw in 2018, when they reached about 1.6 times book and 2.2 times tangible, those were the levels that we aspired to up until very recently. So I think you have to lower those aspiration levels to something because of lower profitability. Maybe we get to 1.4 times book and 1.8 times tangible. But that's the area that I think we're heading toward. But today, it's very tough to see that because of what's going on.
Gerard, just throwing valuation out the window, right? Because maybe it's a moving target, and especially when you consider how aggressive rates have been moving in every which direction over the last, call it, few months or so. Do you think there's a potential that we're going to start seeing some of your peers, it doesn't sound like you, maybe say, listen, maybe some of these large money center banks might be prudent to kind of slow down buybacks, cut dividends, or suspend them, that sort of thing? Because, I go back and I put my 2008 hat on. I think a lot of these financial institutions probably wish they had kind of slowed down the cash return quicker, okay, not knowing what lies ahead. And so I just think it's just kind of interesting that it's easy to kind of say this is now ring fence, Europe's kind of ring fence. I just don't really, that page out of that playbook doesn't make a whole lot of sense to me.
No, I hear you very clearly, and it's an interesting observation. I guess where I would differ somewhat is that unlike 08, 09, or even 1990, those are credit debacles that crushed the banks, forced them to cut and eliminate dividends, pull back buybacks. This is an interest rate problem that is really been driven by, of course, Silicon Valley and Signature Bank failures. So I think what you're going to see is that banks know if they maintain the dividends through the next cycle, which is maybe what we're in right now, they will re-rate coming out of the cycle. So dividend cuts is, I think, the last thing they need to do. Plus, they've got strong capital levels today, unlike 07. Plus, they also have plenty of liquidity amongst the biggest banks.
Right, but you just mentioned that this is an interest rate issue, not a credit cycle. On the other side of this, isn't there likely to be greater defaults on the credit side? And I guess that's the one thing. I just find it really interesting that a lot of analysts, a lot of strategists are very dismissive about that because it's different this time, if you will. And I just don't know. Like, we've already seen what's gone on in commercial real estate. There are some defaults. If you look at some of these REITs, these publicly traded REITs, they look like they're in 2009. So I'm just wondering why there's not more focus on what comes on the other side of slower growth. You're starting to see a lot of really interesting institutions. Apollo, one of them, saying they think there's a hard landing coming. If there's a hard landing coming, that comes with defaults.
No, you're right. We're not in the hard landing camp. But if somebody's in the hard landing camp, where unemployment at the worst in a hard landing reaches 8 or 9%, real GDP contracts over 2%, then the banks are really going to have issues with credit. But that being said, if we're in a soft or shallow recession, we're starting from such a strong base that, yes, there will be higher credit costs this year. We have factored in upwards to 100% increase in credit costs this year versus 2022. Now, granted, 2022 was relatively low. But I'd point out on the commercial real estate side, when you look at that more specifically, the biggest banks have not that, the exposure is not that material, unlike it was in 1990 when commercial real estate was a serious problem for the banks. So yes, there will be some issues. I don't disagree with you. The real question is it a hard landing or a shallow recession? In a shallow recession, I think the banks manage through it without too much difficulty.
Gerard, I was just curious what the temperature of your clients are in terms of wanting to actually buy. I mean, I'm wondering if there's any sort of pushback because so many parties, whether it be regulators, whether it be the analyst community, whether it be the ratings agencies, completely missed what was on the books of Silicon Valley Bank, of Signature. And I wonder if there's any doubt about analysis that is being done on Wall Street, if there's an element of we still don't really know what the next thing is going to be, or we don't have a grasp of what the situation is.
It's a very fair question. And I would say that the unknown that was not expected by myself, or I think most of us, was to see a deposit run accelerate so fast through social media and through Twitter. That is what accelerated the deposit run, which now we have to maybe take into account. But what's interesting, too, is that as we go forward, asking investors how do they want to position themselves in talking to our clients, the investors that have been exposed to banks and have suffered here, of course, they are a little hesitant or reticent to get back in. But the investors that didn't have any bank exposure, they're looking very hard and very eager. When do I jump in? Because they see, as you guys mentioned, you look at past cycles, when the stocks hit bottom, on average, they go up anywhere from 75 to 90%. Now, granted, we didn't fall as much this time. So we may not go up as much. But once we get through this storm, it could be an interesting time to own banks.
Gerard, thanks so much. Good to see you. Gerard Cassidy of RBC.
Thank you.
Another unknown, really quick, though, is that look what happened with UBS and Credit Suisse. You have AT1 debt, which was wiped out, $17 billion for people that thought they were in a different instrument than equity shareholders. So that's the kind of a thing that we just don't know. And this is one of the 30 systemically most important banks. So are these money center banks.
All right. Karen?
Do I want to? Well, I do own banks.
Yeah.
Is that the question?
Well, or
yeah.
if there's an element of unknown because of the additional tier one, bonds that are out there that got wiped out. I mean, you think you're on you think you're in line ahead of the equity holders, and you're not, as it turns out.
Right. Well, I don't know that we have those securities here. So I don't own any foreign banks. I think, I own JP Morgan, I own Bank of America, I own Wells Fargo, I own Morgan Stanley. I think that that's where I want to be in the banking sector. I own no regionals.
Will they be bigger?
Yes.
1 year. Will they be bigger through acquisitions?
Well, deposits are already making them bigger.
And more regulated.
And more regulated.
I mean, more people grabbing onto them, for sure.